Let's review the things you need to know about assumable mortgage. For many people, this type of mortgage makes sense because it gives you several benefits. But there are things you should take a closer look at. Of course, you need to pay attention to the type of mortgage you're getting and the interest rates as well as what you're going to need to do in order to get the rest of the money. But take a look at these things as well. Evaluate the details. Don't just take the seller's word that you can assume the mortgage they have or how much they owe. You want to make sure you get a copy of all the information, including a copy of the mortgage and the beneficiary statement. Look at how much the difference is between what's owed and what you can do to pay that money. Rates for interest. You're going to want to look closely at what the loan rates are. If the rate right now is higher than what the loan has, then you're going to save a great deal of money. In fact, if you can get an interest rate of 5% instead of 7%, you could save $257 a month, which is going to be a lot of money over a period of several years. Fees. When it comes to TRID requirements, which are mandated by the federal government, there are specific rules required. One of those is that borrowers are required to receive a loan estimate from the lender. This explains the costs that are going to happen when it comes to taking over the mortgage. There are going to be a lot of fees associated, but in general, the fees will be more when it comes to getting a new loan instead of taking over the original. You could end up with a huge difference of several $1,000s. Make sure your statement includes things like fees for application, credit report fees, appraisal fees, prepaid interest charge, underwriting fees. You must get approval. You don't get to just assume a mortgage whenever you want. You still have to be approved for the loan by the lender, just like if it was a brand new mortgage. If the lender doesn't approve, then you're not going to get the loan. This also means you have to use the same mortgage company that the original borrower used. On the other hand, you're generally not going to be required to get a new appraisal. That means you'll have an easier time closing the deal, and you're going to save a little on fees since you don't have to pay this one. You can still get an appraisal if you want to, though, to make sure that you're not paying more than the property is worth. Make sure also that you have an idea of the equity on the loan, which is the part you'll need as an independent loan or a down payment. Release of liability. When you start looking at this type of mortgage, however, it's important that you make sure everything is done correctly. If it isn't, the seller could actually still be held responsible for the mortgage. That would mean that if the buyer defaulted, the lender could actually go after the seller to get their money. Make sure that you're following through on all the paperwork and that you're getting a release from the lender that proves you are no longer responsible for the mortgage in any way. That's it for now. On our website, you can find more posts as well as calculators and other financial tools. Considering an assumable mortgage? We would love to know your thoughts, so feel free to share them with us in the comments below. I hope you enjoyed it, and don't forget to subscribe to our channel to get the best financial videos for free.